We're here to try and make sense of the recent weakness in the bond market and the strength in the equity markets. And tell us what it means for the U.S. economy is Ian Lyngen. He's senior government bond strategist at CRT Capital Group. His U.S. government strategy team was recently rated #1 for this year by Institutional Investor magazine. Ian, always good to see you. Welcome to Street Smart. Explain the recent sell-off in Treasuries on Friday and today.
Well, Lisa, there were a couple things at play when we look at the backup in yields over the last week and a half. Even ahead of Friday's stronger than expected non-farm payrolls report, yields had backed up after testing historic lows. And what the data did is it provided a bit of confirmation to the fact that the market had begun to believe that the slowdown might not be as bad as people were anticipating. You saw some strength in equities, which aided a flight to quality sell-off in Treasuries, and that's continued as the week has gotten underway. And we do see 10-year yields now above 215, 220. And that's nearing the place where we would start to think about taking a shot at playing that from the long side.
Well, you say you're near a shot at taking a shot at the long side or getting in and buying on the long side, but I want to take a look at this B of A note that was out this morning. I know you took a look at it, which really tries to sort of call for a recession. It says that there's a 60% chance of a recession that is priced in to the Treasury curve. And they take a look at the 2- and 5-year points on the Treasury curve. Then they do some interesting adjustments based on the fact that the Fed has had a monetary policy that's been targeting pretty much 0%, at least for the Fed funds rate. Make an adjustment. They say based on that adjustment, we basically have a flat curve, which they say pretty much every time since World War II has marked the beginning of a recession. Now, from your perspective, is that the case? And if it is, certainly we should be in buying at the long end.
Well, I'm certainly open to the risk that the economy is moving towards a double dip or at least a sustained period of sub-trend growth. And I'll make the argument that there's not a great deal of difference between a +1% and a -0.25% GDP print from a fundamental growth perspective. The argument that B of A is laying out, it definitely gets you back to a flat curve, or effectively a flat curve, 2s, 5s. But my issue is it does seem to presuppose that all of the quantitative easing that the Fed has done thus far doesn't really give us an effective rate in the very front end that's negative, because that was really the Fed's objective, was to create an amount of quantitative or amount of monetary policy stimulus that mirrored what the world would look like if we could actually go materially negative in the very front end, which obviously we can't. We have the zero bound. So while I might agree with B of A's conclusions, the matrix that they're using is open to question in my mind.
So it sort of seems unanimous when I speak to various analysts that they do expect Treasuries to take another leg up on the price side. Of course, that would mean yields coming down. Do you think by year end we're going to see the 10-year back below 2%?
Well, our call between now and the end of the year is the market needs to go through a process of defining the new low-rate range. Does that mean that we could see 175 again? Certainly, but that doesn't take off the risk that we're going to see a 235 or 240 between now and the end of the year. Our year-end call is actually close to 2% for 10-year yields. And again, a choppy market with volatility as the market comes to grips with what the actual recession or slower growth period will look like in the next coming quarters.
Okay, volatility seems to be the theme across every asset class. Ian, we have to leave it there. Always appreciate the insight. Thanks so much.
Thank you.
That was Ian Lyngen, a senior government bond strategist at CRT Capital Group.